A very warm welcome, everyone. My name is Nicholas Tan from Kenanga Futures, Sudan Berhad. Thank you for spending your precious time tonight to join our webinar. It's a joint collaboration with CME Group in our effort to create awareness and provide education on listed derivatives to the participants. We have returned with our nationwide campaign, Accelerate into the Futures, and stand a chance to win prizes worth up to 50,000 ringgit when you trade Malaysian and US futures contracts from 2nd August until 29 October 2021. So you have like 3 more days to go. Grab the chance and win some big prizes over here. Please take note that futures and options trading involves substantial risk due to leverage factor and may not be suitable for all investors. This webinar is purely for educational purposes. Kenanga Futures Sudan Berhad accepts no liability whatsoever for any direct or consequential loss arising from any use of the content of this webinar. So later, if you have any questions along the session, please feel free to drop your questions at the Q&A box, which is on the right side of your screen. And today we have Mr. David here, and he's going to share with us about trading opportunities and outlook on gold market. So without further delay, I would like to kickstart our webinar by welcoming our speaker today, David. David, over to you.
Hi, thank you, Nick. Just to do a quick sound check, are you able to hear me, Nick?
Yeah, loud and clear.
Okay, I'm just going to share my screen now. Just going to see whether are you able to see my screen.
Yes.
Okay, that's great. Thank you, Nick, for the kind introduction. So let's just start. Firstly, I'd just like to thank CME as well as Kenanga Futures for inviting me to speak on today's topic entitled Trading Opportunities and Outlook on the gold market. I know there's, if you have been following the market, everyone is talking about the equities market. Everybody's talking about commodities in general. If closer to home, you look at palm oil prices, they are almost reaching like all-time high. So gold, in certain ways, it has gained a bit of luster. And just last year when we were about to enter the COVID crisis, gold rallied from as low as 1,005 up to as high as 2,000 US dollar per ounce. But since then, I think it adjusted, and right now it's basically on a consolidating phase. So I think it's interesting at this point in time to talk about gold. As we go forward, things will get more interesting, especially in global markets. And we're likely to see how gold will fare in that kind of environment. So I'm just going to reiterate what Nick just mentioned earlier. I think whatever I presented here today is basically based on my personal opinion. It doesn't reflect any opinion by Kenanga Futures or even by CME Group per se. And dealing with futures does involve a lot of risk. So make sure you do consult your licensed representative for next course of action. Now, here's some of the key things which I'm going to be touching about in this webinar. I think firstly, it's good that we have a look in terms of where is the gold and silver market is in terms of their fundamentals. Are we seeing the market to be a bit more overvalued than what it's supposed to be? So diving deep down into certain fundamental factors can provide you some insights as to where the gold and silver market will probably head to. And as we commodities or even in equities market, seasonality is something very important to play, especially for traders who are trading the market. You'll be very careful when you're approaching, let's say, periods where prices tend to be stronger based on historical basis, because at those point in time, if historical can repeat itself, but obviously there's also certain instances where prices doesn't reflect the historical pattern. So I think this is where a trader need to be very sensitive. But seasonality does provide you a guide. So say for example, I think if you just look at gold, which I'm going to share it with you later on, there'll be periods where gold are strong. Prices of gold is strong, and there will be period where prices of gold tend to be weaker. So if you are navigating the market, it's good and it's important for you to observe those seasonality pattern. Now, as a trader, I think if you are trading a market, understanding fundamental is not sufficient. You still need a bit of grasp of technical basis. I think one of the key tools I always use in my technical trading is always to look into Heiken Ashi as one part of type of candlesticks, which is slightly different from Japanese candlesticks. So which I'm going to share on later part in the second part of my webinar. Last but not least, I think every trading decisions that you make, be it whether you're a full-time trader or you're a part-time trader or you're probably just taking a position in the market, you must have a proper risk management tool. So I'm just going to share you what are the key tools that you can use to manage your risk at every trade that you enter. Now, just to share with you the performance of gold in general, I think if you just look at it, gold as a commodity, in the whole commodity basket, it has not been performing that well. Obviously, last year when we were at the peak of the COVID crisis, we saw gold breaching the $2,000 for the first time. But thereafter, with the vaccine, with economy starting to reopen, gaining traction, we start to see a lot of investors are starting to pile up into equities rather than gold. And in fact, we saw a lot of outflow from the gold market. Now, funny to say that you look at other commodity asset classes, like for example, like crude oil, or in fact, even your grains like your wheat, your corn, or in fact, even like your palm oil. Those commodities has been on a super rally. Oil is almost touching almost 85 to $90 on Brent. And if you just look at some of the key agricultural products like wheat and corn, at least compared to last year, they are probably doubled their price. But gold, on the other hand, despite reaching an all-time high prices, it gradually tapered down, especially in early part of this year when economy starts to reopen, and as countries starts to come out from the COVID crisis. So in a way that gold act as a safe haven asset, it still remain very relevant. But when things are getting better, investors don't find the need to actually go back into the gold market. Therefore, that explains why gold has been actually an underperforming asset class so far, at least for the first 10 months of this year. Now, it's crucial to watch. Obviously, there's uncertainty in global scene, with Federal Reserve talking about tapering, talking about hiking interest rates. And obviously, the key buzzword right now in the market is talking about inflation. So, if you look at historically, gold is always a good asset to hedge against inflation. So it's interesting to watch. Right now, we are seeing the effect of inflation, whether gold prices will tend to be supported. That's something for us to watch out. If you're already trading the market, it is something that is worth to take note as well. Now, when it comes to any product, be it gold or be it any other markets, you can approach the market through two basic camps. One is a fundamental analysis, one is a technical analysis. Fundamental analysis obviously talk about market economics, market dynamics, supply demand situation, then obviously key government policies, or if you talk about agriculture, then you talk about weather reports, planting progress and all this and whatnot. So fundamentals really dive deep into what are the market dynamics. However, on technical analysis, it's slightly different. Technical analysis just focus on price and volume. You're just looking at your chart and you form your decision accordingly. So in a way that a lot of traders will incorporate both analysis together to really form an opinion. So say for example, if supply is tight, you expect prices to go up. But obviously, if you look at a chart, you cannot be entering at a peak. You're trying to enter probably a pullback. So technical analysis on one hand helps you to identify areas for you to enter at a better price and areas for you to exit at a better price. So I think these are the two basic fundamental camps that, whether you are trading for a full-time basis or trading on a part-time basis, you do encounter, such deviation. And obviously, it's in a way you need to incorporate both when you analyze the market and when you position your trades accordingly. Now, if you look at gold in relation to other asset classes, if you are trading gold, there's always certain important factors you need to consider. So say, for example, the number one factor you need to consider is the dollar index. Now, dollar index measures the strength of the US currency against a basket of other currencies. So obviously, when dollar gains strength, nobody will favor gold. In fact, a lot of people will favor US denominated assets. So in a sense that gold actually move inversely to the dollar index. So whenever you see strength in the dollar index, gold will not be favored. But however, when you see weakness in the dollar index, you can see gold tend to perform positively. So this is one of a common relationship which a lot of those who are trading in the gold market, they were likely to use this as to form a basis of opinion. So say, for example, if they have the view that the dollar index will probably become stronger because, with the anticipation that the Federal Reserve is going to hike interest rates, US dollar will probably gain some strength. So in that sense, gold will not be favored. So, a lot of traders work around this relationship. Now, if you compare other asset classes like commodities in general, gold as a part is a precious metal. Its performance does relate to other commodity asset class like crude oil. So if you compare crude oil chart and gold, it shares a lot of similarity. Actually, both the prices move in tandem. So this is something that we need to take note of as well. So if you look at gold performing, most likely other asset classes in the commodity space is also performing. Bonds, on the other hand, also share a similar tendency, which is both if global bonds market are moving in price, you can see gold market also moving in price. Then obviously, gold is very tied to the markets. Last year, we have seen how gold has breached the 2000 because you look at some of the major economies, they actually was under a lockdown, and both the equity markets for this kind of markets actually went down into a negative territory, and therefore a lot of investors, it's like a flight to safety. So you can see a lot of inflows into the gold market. So in a way that whenever equities market in general do well, people would tend not to favor gold. And vice versa, if the market is not doing well, people tend to go into gold market because it gives you a bit of hedge in terms of your portfolio diversification. So I think that's the role and that's the relevancy of gold in the global context. And that's something important, especially when you're trading gold market. It's good to have this kind of generalization, so it helps you to navigate the relationship between the different asset classes in relation to gold. Now, since gold is quite tied to equities market in a sense that both have an inverse relationship, it's important for us to assess how do we see the global economy. Are we going to see any headwinds? Obviously, this year and last year, we have the COVID crisis, which is still in. We are still in the COVID crisis, and that really had an impact on the economy as well as the equities market. That actually prompted government across the world to really pump monetary policies into their respective economy. So therefore, we can start to see very strong recovery. So in the beginning stage of COVID crisis, we saw that gold tend to be favored because equities market was not doing well. In fact, we saw massive plunge in the US Dow Jones. Actually, that caused a flight of assets over to the gold market. And that caused a big rally from what we see, $1,400 per ounce, right until $2,000 per ounce. So economy growth does plays a very important role. So for us to really track where the gold market is going to go, it's important for us to also relate where the economy of the world is going to go. So what I have here is basically to look at IMF projections. So they have revised lower because I think really what's concerning in the global scene is, everyone is talking about China. I think just a couple of hours ago, there's a news report that China has shut one of the city because of the fear of COVID, spread of COVID between the intercities. So with countries going, into a possible lockdown, that will affect economic growth in going forward. And that will likely be a catalyst for the gold market to gain some ground. Because when economies are not doing well, equities market is probably going to see some softness. A lot of people will actually rush into the gold market. So I think it's important for us to take note how the economy of the world is going to perform going forward. Now, another key parameter or important tool that is what we're going to see in the next few quarters is obviously in our mind will be the rate hike cycle. We have been, after the global financial crisis, we have been in a scenario where we have seen interest rate to remain very low, and it makes us very comfortable to take on more debts. Now, obviously, and last year with the COVID crisis, it actually prompted a lot of countries around the world to incur heavy debt just to get out their economy on a strong footing. And I think, whatever policy there is, you must come to a point where, you tend to see the effect lesser and lesser, or what we call a peak in policy. And I think what a lot of people are expecting is that as countries are already putting so much debt, eventually they have to taper those debts and they have to start increasing interest rate when their economy are gaining ground. And that's what we are seeing in the picture right now. So here I just taken from Bloomberg, you can clearly see some countries are actually going into a higher interest rate cycle. They're starting to hike interest rates as a way to contain what we call inflation. With so much policies going into the market, monetary policies going to market, money printing, then obviously asset prices will tend to be inflated. And that causes, a concern for, government policies because, they have to contain inflation. If not, a lot of people will suffer. Rising price level is not going to benefit anyone. So I think that's a way to really contain inflation is to hike interest rate. And that's what market as in general is expecting. So I think going forward, interest rate cycle is going to be expected to go higher. Given economic conditions are still favorable. So with higher interest rate cycles, if you look at historically speaking, when you have a high interest rate environment, it's not beneficial for you to really park your assets into gold market. So higher interest rate environment doesn't really benefit gold that much. But again, the inflow to gold market can change. But if you take it in general, whenever you see a high rate cycle or high interest rate environment, generally you don't favor gold because gold is not an asset that pays you dividend. So in a sense that you're really losing on the opportunity cost whenever you have a high interest rate environment. So do watch out. I think everybody's expecting the interest rate is going to go up, and that will likely be counter effect on the gold market. So I'm not going to talk too much on the commodities in general, but if you look at it, prices across the board has been rising. And if you are trading on the agriculture space, like corn and soybean or the CME market, you probably have seen those, or you probably witnessed those markets to actually experience double rate in terms of their price growth compared to last year. So that's what's talking inflation. So if you look at across the world, everyone is talking about hyperinflation because commodity prices, especially food prices, is actually on the rise. And this is concerning to government policies because government will have to step in to really to moderate the inflation pace. If not, it's going to create a hyperinflationary environment, and that's going to be a concerning going forward. So I think interest rates is another tool, and eventually we have to be comfortable with interest rate, which is going to get higher as a way to contain that inflation level. So we look at it, I think commodities as a cycle itself, we are on an up cycle. May not be a super cycle because super cycle will really talk into commodity being on a very high level for a period of time. Right now, we have only just seen most of the commodity breaking away from the 8 to 10 years price level. For it to really sustain or call it a super cycle, we need to see this kind of high prices to sustain at least for more than a year or so. So really, it's still early to tell, but we really have to be comfortable with commodity prices at this level. It's hard for commodity prices to adjust its price lower, given the current dynamics that's in the market. So I would say the commodity itself in general is really on an upcycle. Now, what's compounding the problem is that we look at news, flash news on the media. Everyone is talking about logistics. There's a lot of constraint. There's not enough ships to transport products from inter-countries. There's even ports, lockdown in certain ports, which cause congestion. So shipping costs is, you look at Baltic Dry Index, which measures the shipping cost. It has been almost an 8 to 9 years high, and it's continued to lingering around there. And that will put a lot of pressure on importers because importers, when you face with higher shipping costs, they have to translate the cost down to the consumer. So eventually, these are mechanisms that really fuel the inflation going forward. And the narrative of high interest rates is going to be very supportive because the inflation is set to go higher. Now, this is what some of our economists are forecasting. The current tight supplies we are seeing in the agriculture space, mainly in the agriculture space, will likely be only be moderated probably by second quarter or third quarter next year. So there's still ample of time, or in fact, if you look at it, there's ample of opportunity for this kind of agriculture prices to even go higher with such a tight supply situation. So I think early part of this year, Federal Reserve was saying that inflation is something that shouldn't be concerned because to them they feel that inflation is going to be a short-term thing. Probably it's going to be run off in the next few months. But since they last identified that kind of narrative, it's almost close to 10 months now, and inflation is still persistently very stubbornly high. It goes to show that Federal Reserve might be behind the curve. In a sense that the hiking interest rate cycle, they might be a bit slow, but this goes to show inflation is going to be here to stay for the next couple of months, right even to a year. So I think that's something that's very concerning to the policies maker point of view. Now, why inflation is so scary? Now, inflation is scary in a sense if you have an economy that is not performing well and inflation is stubbornly high, you're going to come into a situation where there's a lot of buzzwords that's throwing around, we're going to be ending up in a situation where we call a stagflation, where economies are stagnated, but your general price level is still high. Obviously, this is something that government policies do not want it, and they definitely try to rein in inflation. So I think this is another crucial thing to watch out. Whether you're in the equities market or you are in the equity space, they're bound to have a bit of volatility whenever you see government intervening in the market through policies measures. So I think this is a narrative which is going to be, we're going to be closely watch out for at least the next few quarters. Now, rate hike is what we are expecting in 2022. So again, I think going back to what I said earlier, when you come into a higher interest rate cycle, that shows you that a lot of outflow is going to be coming out from the gold market, favoring other asset classes like probably your money markets, which now going to generate higher interest rates. That's going to be an environment where people will tend to expect when you have a higher interest rate environment. So I think if you just look at some of the Federal Reserve comments, it looks like next year we're probably going to see 2 or 3 hike cycles on the upwards. But that's assuming US economy still remain very strong. If US economy shows sign of weakening, I think they probably will delay the hike cycle. But if you just look at inflation level, I think that's something that they really have to be concerned of. They usually target Federal Reserve target of inflation is about 2%. Right now, we are doing about 5%. And with economy that's growing quarterly to quarter about 5 to 6%, we are only looking at a buffer of probably less than 1% to really counter the effect of inflation. So that's a very tight margin. The only thing is that really the economy in US really have to grow into a significant pace to really stem some of the impact of inflation. But I think eventually rate cycles will have to go higher in order for inflation to tame down. Now, here are some points into why inflation is getting persistent. First of all, I think last year, as a response to COVID crisis, there's a lot of money printing into the system. So a lot of asset classes has actually benefited out of this based on their rise in their asset prices. Secondly, I think commodity prices is something that we have to watch out because when you see commodity prices stubbornly high, that shows you that inflation is going to remain on a very high level. It's not going to come down. I think mainly you look at oil, for example. Last year you are talking about negative prices, first time in history. Now, right now we are almost talking about there's reports or even narratives saying that prices of crude oil may even touch back the $100 mark again. So it goes to show, I think, really there's a lot of tight supply situation and demand is coming back on stream. It's really pushing prices higher. So with that regards, I think inflation is going to be a concern moving forward. So I think reduced globalization, made at home policies, I think these are also talking about logistical issue. And with vaccination in progress, I think economies are starting to reopen, and that's going to create a lot of pent-up demand. So now I think the risk of stagflation is quite, I would say in general, the US market right now is quite perverse in a sense that we should expect interest rate cycle to go up. But on the other hand, because of the inflation is going up, but on the other hand, we see that the US economy in terms of their growth might face a little bit of headwind into the next few quarters. One, for example, if you just look at China is slowing down with COVID cases spiking. We expect certain cities to be under lockdown, like what we are seeing today, and that could really impact on their economic growth. So US is actually heavily reliant on China's economy. Like I said, if inflation is staying at this level and you don't have that kind of growth, reaching at 5% level, technically we should see, US economy in general being in a stagflation mode. Now, if you look at historically speaking, when markets are in a stagflation mode, normally gold will perform very well because, first of all, you have a high inflationary environment, and secondly, you have a low growth. So in low growth scenario, a lot of investors will put their assets into safe haven assets like gold. And when you have inflation going higher and higher, a lot of people actually put into gold as an asset class because historically speaking, they have proved to be a good hedge in terms of inflation whenever you encounter a high price environment. So I think that historically speaking, when you look into a possible stagflation scenario, gold in general has performed very well. But again, I think so far we have seen the numbers. It looks like U.S. economy might avoid a stagflationary mode, but we are not sure going in the next few quarters. So again, it all depending on how the economy in general has been performing relatively to other economies around the world as well. So this again proved the point. I think especially when you have high inflationary environment like what you are facing now, gold all the while has been performing very well, historically speaking. Now, if you compare equities market and gold, there will be time where, just like if you go back last year, early part of last year, when COVID crisis just really was on the beginning stage, we really can see that when equities market tumble, like what we've seen in the US market, really gold was the good safe haven hedge where, you see gold prices tend to go stronger because there's demand or rather inflow going to the gold market. If you trace all the way back to 2008 global financial crisis, again, you see the same thing. When there's uncertainty, when there's a crisis in making, a lot of people actually go into the safe haven asset class, which is gold is in favor. So if you just look at portfolio as a diversification, gold can act as a very good diversifier in terms of moderating your risk, your overall risk to the market. And historically speaking, I think gold maintain that kind of stand and as an asset class, and I think today it still remain very relevant. So the question is, are we going to see weakness in the equity market that actually can be supportive for the gold prices? Now, if you look at the US market performance in general, last year and this year, you look at your S&P 500, you look at Dow Jones, these markets are actually reaching all-time high. So generally, when you have all-time high markets, gold will not be in favor because a lot of people will prefer to put their money to equities market. Again, I think gold is good during a crisis, but when you have a good times, normally gold will not be in favor. So you look at the ratio between the S&P 500 and against the gold price, you can clearly see that the S&P 500 outperform gold on multiple levels. And I think this kind of performance will continue because with so much money printing that's going on, although there's stocks of tapering, I think generally people are still favoring the equities market. So in that sense, the performance of the equities market against the gold will continue to outperform. Now, things will change if, let's say, there's an impending crisis. It's very hard for us to time crisis. But if if really there's another crisis that's coming, I think gold will likely be remaining again another important safe haven hedge against any potential crisis. Now, understanding the equities market is important because it does give us some insights as to where the gold market can probably hit to. For the simple fact that when you have a strong equity market, you probably wouldn't expect gold prices to break or to see a big rally because, again, I think when equity markets do well, means the general economy also does well. In that sense, if you see softness in the equity market, probably is a good time for us to really look into the gold market. So right now, obviously, I think September, and if you just look at seasonality of the S&P 500, September and October usually are a period of volatility. Out of 20 or 30 years data, you can clearly see September and October are what we call the weak months. But when it comes to November and December, that's where the index itself take a major rally. It's probably due to holiday effect, year end, people want to have that kind of euphoria or optimism in the market. And having said that, that shows that, as we move into the fourth quarter of this year, with equity markets expected to perform well, normally we don't expect gold prices to do well because when equity markets do well, that means there's a lot of positive sentiment in the equity space. And therefore, that's where the money's flow is going into those markets instead of going into the gold market. Now, I think everyone is also anticipating when could be the potential bear market scenario. Because when you see a bear market scenario in equities market, that will be a good time for someone to really look into the gold market. But right now, I think we have been anticipating. But if you just look at the charts on S&P 500 and Dow Jones, they're actually all breaking new highs. So in fact, I think the bull market still has some leg to go. And as we approach towards the year end, normally we will probably witness a few rallies, especially in the equity space. So really, I think when it comes back to the gold market, we probably may not see much of an upside because the sentiment in the equities market is still strong at the moment. Now, so that's gold is a very good hedge against crisis, especially economic crisis. Now, not only economic crisis, we have a health crisis. We are still in a health crisis. So you look at it, I think when the onset of the COVID crisis hit us, we saw gold took a massive rally. But I think when vaccination came into the market, when economy start to reopen, that's where we see gold performance start to taper down. So what's interesting is that gold performance during a health crisis, I think probably this is the first time they are seeing it, and what we can really relate to. But generally, I think is that when we are in a health crisis, any dynamics can change. So example, if there's a new variant that is spreading, or and it will make certain vaccine render certain efficacy of the vaccine, then probably you're going to see a lot of people are running into safe haven assets back again. So I think gold in that sense will tend to gain more ground. But generally, I think in any crisis, be it in a health crisis or even in an economic crisis, gold normally will act as a safe haven. Now, I'm not going to touch too much on the relationship between gold and US Treasury yield, but if just look at the reason I show this because, as a trader or someone that's watching the gold market, it's important for us to distinguish what are the asset classes that can relate their performance to the gold market. So what we have is that whenever you see yields tend to go higher, normally we see gold prices tend to get weaker. Reason being is because when Treasury yields goes higher, that indicates a lot of pressure on the Federal Reserve to increase interest rates. When that said, when higher interest rate, normally you don't favor gold. So there's a bit of relationship in there. However, you cannot just rely on this relationship because ultimately the factors that drive gold prices is just not only Treasury yield. There's other important factors also to take into consideration. But it's important for us to identify that this is a potential factor that actually drive gold prices. Now, if you put it into another, if you characterize the Treasury yield in another way, is to look into what we call a real Treasury yield, which takes into account your inflation. So normally when you have a negative real yield, that means that the inflation is higher than what is the yield of the bond. In this case, it's the US Treasury yield. So when you have negative environment, normally tells you that inflation is high. And in this scenario, if you plot the price of gold against the real yield, the real US Treasury yield, you notice that it's such a similar tendency. Both these asset classes move in tandem. It goes to show that when you have high inflation environment, it is actually positive for gold prices. So now the only key question is, will inflation be a good parameter that outweighs the hike in interest rates, the effect of a hike in interest rates? I think that remains to be seen. But when you have inflation environment, high inflation environment, that's a concern in general. And normally that will favor gold prices. So I think I think this is some of the key attributes that we need to look at, especially when you're trading the gold market. I'm not going to go too deep on demand and supply. Generally, the demand and supply dynamics of gold is actually very stable. When it comes to supply for gold, it's always very constant. We don't see any big supply or a decline in supply for the gold market. It's a very constant supply of gold every single month, year in, year out. The demand, however, is slightly different. Again, I think when it comes to demand for gold, you always talk about whether gold can act as a safe haven. And as mentioned, whenever you encounter crisis, as what you have seen, what you are seeing right now, the COVID crisis, gold will tend to really do its role as a safe haven. If you just look at this chart, you can clearly see just last year during the peak of the COVID crisis, we saw a huge demand coming to the gold market, be it from the jewelry standpoint or be it from the investment standpoint, which is your ETF and your exchange traded products. So there's four major demands for gold. I think the two key things is always your jewelry demand, which is a physical demand for gold. And secondly, is about your investment demand. So investment demand is really relying on your ETF or even your exchange traded products, which is underlying the gold market. So when you have massive inflows into this type of products, normally indicates there's strong demand for gold, and prices will tend to rise. And vice versa, if you start to see, inflows are starting to decline or even go negative, that is an outflow. Normally, you see prices tend to come down. So what we are seeing right now is that, the ETF flows into the gold market is actually quite, I would say it's quite small. Reason being is because there's not much incentive for someone to really go into the gold market. Given that, you have low interest rate environment, the equities market is doing very well, and that's what's causing the kind of decline we are seeing in terms of exchange ETF flows or even ETP flows. Now, having said that, again, during a crisis where things are very uncertain, we tend to see gold prices tend to perform very well. So I think what I want to mention here is that, look at it in terms of when you see there's a lot of uncertainty ahead, that's where market tend to favor gold in general. So I mentioned 2020, we saw the big spike. And again, in 2008, during the global financial crisis, we saw a big spike in gold market. Now, if you look at it in terms of having gold as a part of a portfolio, I think it does help in the sense that it moderate your risk against the market sentiment. Now, other major demands for gold is talking about central banks demanding physical gold. Again, I think this again is a very constant demand. Year in, year out, we don't see huge increase from central banks demanding more golds. But things can change when there's a lot of uncertainty. So, for example, if let's say a central bank want to put a bit more reliance on having more physically backed gold, they probably will demand more, and that can in a sense can push up prices for gold. But you can watch out this space. In general, it won't have that much of impact as compared to your jewelry physical demand, as well as your investment demand, which is the two major components when it comes to the demand for gold. Here I show you the supply of gold, which is I would say it's very stable, very stagnant. You don't see a big spike in a single year, especially when it comes to supply of gold. It's very rare to have that. That means that there's a lot of mining activity, because I think miners in general, they will probably have a fixed quantity that they will mine every monthly. So we don't see a big supply or suddenly a big surge in their supply coming on stream into the market. So supply of gold in general is actually quite moderate in a certain ways. So what really drives the gold price is actually the demand for gold, and that will really relate to whether how gold act as a safe haven and really how gold can behave, especially when you have or when you encounter economies that's in crisis. Now, another important element for us to observe for someone that's watching the market is what we call positions in the market. If you are trading on a CME space, we always have CFTC data, which comes out every week, every end of the week, which actually shows you whether the market is in a net long or net short positions. Obviously, if you look at futures market, you have an open interest, and most of these open positions are now putting long positions in the market. You would expect the prices in the market to be supportive. Vice versa, if you're seeing a rally right now and a lot of these positions that's open in the market is is a short position, that shows you that the rally will not last. And in fact, you look at it, right now the gold market, why the gold market has not seen a very big rally of late, is because a lot of positions in the futures market is still pretty much long positions, but those numbers are declining. I think a lot of those who have long late part of last year and early part of this year are probably closing out their positions, and that shows you that their net long positions are declining. So going forward, it's important for us to watch out, because once it goes negative, that means the market is going to a net short positions, and that's where you can tell prices will tend to be on the downside, because most of the market participants are shorting the market. So right now it's still a net long positions, but those numbers are actually declining. So it goes to tell you that, any big rally in the market will probably witness quite a quick pullback in terms of price rally. Now, if you look at seasonality, if you're someone that want to observe price trend, if you notice that, especially when you come to second and third quarter, normally these 2 quarters are not very good in terms of gold performance. But when it comes to the fourth quarter, normally gold will perform quite good. This is backed by physical demand, because during the holiday season, you tend to see a bit of pickup in terms of physical gold demand. So fourth quarter usually is considered quite a good quarter, especially November and December period. So now we are entering into what we call a good quarter in terms of the gold price. Are we able to see the kind of seasonal tendencies again? We are quite likely, but again, there's a lot of headwind, that's into the market as well. Because as long as equity markets are doing well, we don't see the kind of upside in gold prices, because many people will tend to favor other asset classes as compared to gold. Now, if you talk about gold, it's important for us to relate to the silver market as well. So if you look at it, just last year we saw a big spike in gold, but we don't see the kind of spike in the silver market. In fact, if you look at, there's a ratio that we always see, the gold to silver ratio. I think it went as high as, it went as low as, I think, below 60. But then again, I think early this year, there's a lot of talks on silver, because it was deemed as an under appreciated asset, and in fact underperforming to gold. And there's a lot of sentiment, and there's a lot of traders were actually piling positions into silver market, and it closed up the gap. In fact, I think if you look at the gold silver ratio, which is a very common indicator, it went to as high as 120, which is tremendous. That shows how gold has so much outperformed the silver market. But I think early part of this year it catch up. Silver market did had a very good catch up. It actually narrowed up the ratio right down to below 60. But right now it's doing back to its 80 level, which is a long-term average. So if you look at in terms of relative performance, the gold and silver market is quite balanced at the moment. But what is important is that when you see extreme like this, like what we've seen early part of this year, normally is a good chance for you to be taking positions either in the gold or silver market, because that's where if you are a mean reversion type of trader, you like to take this kind of opportunity when there's extreme or there's a tear in certain ratios. So again, it's a very good ratio to watch out if you're trading the gold and the silver market. So gold and dollar index, if I show you in the earlier slide, is a very important asset classes to look at when you talk about gold, because whenever you see strength in the dollar index, normally you don't favor gold, and vice versa. When you see weakness in dollar index, normally you see strength in the gold market. So the direction of the dollar index really depending on how the US economy is going to go. And the interest rate expecting to go higher, normally you expect dollar index to go higher. And that will really put pressure on gold market. So it's fascinating to see in the upcoming FOMC meeting in November, how we're going to see the reaction of gold and the dollar index market is going to play out. Now, obviously, I think when you talk about gold and other asset classes, there's up and rising alternative asset classes, which Bitcoin, for example, I think it's taking a lot of attention out of gold. Therefore, you cannot see a bit of, you can't see the kind of relevance as gold or being a very good safe haven asset. So if you look at it, if you compare the price of gold against the Bitcoin, you can clearly see there's an inverse relationship playing around here. Bitcoin in general does work very well in tandem with equity space. If you track Bitcoin and S&P 500 or even Dow Jones, it does shows you a very strong relevancy over there. But when it comes to gold market, it actually moves in inverse direction, which means that when you see gold prices goes higher, you tend not to see Bitcoin following that. And when you see Bitcoins going higher, you tend to see gold actually soften. So this is a very interesting scenario in a way that I think both the asset classes are actually competing in certain ways. But I think, again, if you talk about historically as a safe haven asset, I think gold has shown historically that is seen as a safe haven asset. So when there's a need for funds to really park into a safe haven asset, I think gold can gain a bit of prominence as compared to Bitcoin. But it's interesting to take note of this relationship, because I think Bitcoin is slowly gaining prominence as it's almost reached its all-time high prices, and that will likely be an impact on gold prices going forward as well. So that's on fundamental perspective. Moving on into the second part of the presentation, I think talking about technical per se. So I think first thing, when you look at any markets, it's important for us to look into the overall trend of the market. Is the market trading higher, or is the market in an uptrend or the downtrend? I think one of the easiest way, besides looking at the chart graphically, is to look into plotting the overall price chart with a 200 EMA period. So as long as prices are trading above that line, that shows you the market is actually on an uptrend rally. Now, if it breaks that 200 period EMA, that shows you that the market is probably going to head to a downtrend. And this 200 period EMA not only act as a way for you to determine the trend, it also provide you the support level as well as resistance point for prices to react. So right now, you look at, this is based on the silver market. Silver is very interesting in a sense that it's actually touching the 200 period EMA. If it does break above that, that shows you that the silver market can have some leg to go higher. But if it doesn't, that shows you that the silver market may poise to go lower. So the 200 period EMA is not only act as a way for you to identify the trend, it also act as a support and resistance point. Now, gold market, it's been consolidating around a 200 period EMA, but it's still generally trading below, which shows you there's weakness. I think this was taken probably a couple of days back. Right now, gold is doing about slightly above 1,800. That shows you that it's trying to break away from the 200 period EMA. So crucial to watch the next couple of days, especially when you head to FOMC meeting, whether gold can sustain above the 1,800 mark. If it does, that shows you that gold in general can still sustain a very good momentum on the upside. Now, besides looking into the trend, sometimes it's also good for us to look into certain distinguished chart pattern. So what we see in the gold market, we saw what we call a descending triangle pattern. Now, in descending triangle pattern, normally, we want to focus on breakout. So again, if you look at right now, the chart is pointing that if the price break above the 1,800 mark and stays there, that shows you that the gold is potentially breaking out of its triangle formation. And in fact, I think, probably the next rally it will bring it to at least 1,900. If it doesn't, it's probably going to retest the support again at about 1,725 level. So it's crucial. Not only we look into the trend of the market, if we can distinguish the particular type of pattern in the market, is also equally important. Now, silver again, I think you can see that the market is consolidating, and we have reached a high this year at about 30 US dollar. So it's waiting for it to really see, can we reset that kind of level. If it doesn't, then really we're looking at 21 US dollar again as a strong support. If it does break that, technically, the silver market is on a downtrend. Now, once you identify the trend, it's important for us to really distinguish the trend of the strength of the trend. Now, in a trend, normally prices go consecutively higher or lower, but a market cannot just go on every day on a series of higher highs or even on a series of lower lows. A market would tend to take a break, especially in a trendy market. So when a trend takes a break, that normally tells you that normally you'll witness a pullback or a throwback in terms of the prices. And how do we measure that? We can measure that using an indicator called ADX, which is average directional line, and that will tell you whether the trend of the strength still persists. So right now you can see that ADX showing you is trading about 20 points, which tells you that the market in general is still consolidating. Despite, if you look at the overall trend for the past 1 year, it's still an uptrend, but the trend is moving into a sideways market. Now, it's dangerous when the trend is moving to a sideways market. It's either could be telling you that the uptrend that we're seeing for the past 1 year could show exhaustion, and if it does break below the crucial support level, it tells you you're going to come to a new trend. And if not, hopefully during this consolidation period, it will continue its uptrend again after given some time. So I think ADX does give an indication whether the market is clearly on, on the trend of the strength is still strong or not. So I'm not going to go too deep on the values of it, but do understand that, whenever you have low values in ADX, that tells you that the market is consolidating. And you have a high ADX value, that shows you that the market is strong in terms of the trend. And you should be finding positions for you to enter with the trend, not against the trend. Because I always believe, if you are in position against a trend, it's not always a good business to be in. So I think in the agenda slides, I did mention, using Heiken Ashi as a way for me to navigate my entry and exit. The reason I chose Heiken Ashi is because if you compare to normal Japanese candlesticks, there's so many patterns. Japanese candlesticks alone has 100 over different configuration, and it's not easy for a trader to go and really identify all the 100 different patterns that's available. So one of the easiest way, especially when you identify the trend already, is to use the Heiken Ashi candles instead. So really, there's only three distinct patterns of Heiken Ashi. One of it is if you see a red or green candle bar with wicks on top, top and below, that shows you the trend is actually weakening. If you see only one wick, if for a green bar the wick is always top, the red bar the wick is always below, that shows you the trend will continue. And if you see like dodgy type where the body is very short and the wicks are long, that tells you the market is consolidating. So, a very classic example, and it's very easy to identify. The only downside of Heiken Ashi is that it doesn't take into account gaps. So if you are a gap trader, you want to look into gaps, Heiken Ashi may not be that suitable. So I think that's something for us, for you to take note if you are using Heiken Ashi. So dynamics of Heiken Ashi, whenever you see red candles, that's where you should be thinking position to sell. And when you see green candles with single wick, that you'll be taking position for you to buy. And when you have series of red and green together, side by side, normally it tells you the market has no direction. And normally, if you are a trend trader, you probably need to wait until a clearer signal, or if you can change the strategy and do a sideways market strategy. So besides Heiken Ashi, I incorporate the moving average crossovers to give me a better position for me to enter and exit. And moving average crossovers is basically I use two different type of period EMA. One of it is a 9 period and the other one is 20 period. So one is a shorter term and the other one is a longer term. So whenever the shorter term crosses above the longer term, that means the market is going to be on a bullish phase. So, and I accompany that by, if the Heiken Ashi is a green candle, normally that tells you it's a good time for you to be entering a long position in the market. Vice versa, if the shorter term crosses below the longer term, it tells you it's a bearish crossovers. And if you see a very white red candle bars on Heiken Ashi, that tells you it's a very good position for you to enter a short position. So once you incorporate both Heiken Ashi and moving average, it does give you a better signals in terms of timing your entry and exit in the market. So last but not least, you must always have a risk management tool in place, because going into a market without risk management in place is really putting yourself in a very dangerous position. So one of the tools that I use for risk management is what I call ATR, average true range, which measures the range of a daily bar basis. So for me to set, it's not so much of setting my profit target, it's more important of setting my stop loss. So for example, let's say if I take a gold futures chart on a daily basis, on a 4-hour basis, you can clearly see the ATR value is about 12 points. So if you work your risk to reward ratio, which means that if my ATR value is at 12, and I work risk reward 1 to 2, that means if I'm willing to lose 12 points to target a profit of 24 points. So that's how I use ATR as a way for me to measure my stop loss level. So right now here, what I have here is that if you look at the candles, we have a bearish crossovers, you have a red candle on the Heiken Ashi. That's a good position for you to take a short position. And when you take a short position, you can immediately calculate your stop loss level, which is based on ATR value is 12 points above your entry, your short entry. So that's how you manage your risk. And I think it's important for someone to manage his risk accordingly. So I think what I mainly talk here on gold market is relevance to the futures contract per se. Obviously, there's a lot of ways for you to gain exposure in the gold market. You can go through via ETF or even investing in the mining stocks. But what is important is that, to gain a direct exposure in the gold market, there's no other better instrument than the futures contract itself. So I'm not going to go too much in detail on the definition of futures contract. You can always check with Kenanga futures representative. They'll be more than happy to explain it to you. But what is important is that when you are trading the gold futures contract, COMEX is a very liquid market. And COMEX is also part of CME. If you look at the contract size, it's about 100 ounces, and price code are in US dollar, and every tick size or every tick value is about 10 US dollar. So I think it gives a lot of varieties. And this is talking about the COMEX gold contract. There's a lot of variation of the COMEX gold. You have the mini gold, you have even the micro gold contract that's available for you on the CME exchange. So if you really want to gain that kind of exposure in the gold market, and I think one of the best ways is to really look into the gold futures market, because there's a lot of liquidity. If you just look at these numbers from CME website, the average daily volume in the gold market, you are talking about 400,000 contracts easily, and that's actually a very liquid market. So really, I mean, if you want to gain exposure in the gold market, I think gold futures as an instrument itself, it provides you a lot of relevancy, especially when you gain a bit of exposure when it comes to trading the gold market. So with that, I'm just going to end here. For any questions that you may have, I'm happy to address. I'm just going to pass it to Nick for the next part of the session.
Okay, thanks, David, for the wonderful sharing. So if you have any questions, you can post it on the Q&A box.
What are you clicking?
Click KenangaFutures.com.my, Malaysia's leading derivatives broker.